Hi. Many people seem to think there's some kind of magic to building a three-statement model, otherwise known as an integrated financial model. We hear about people struggling to make their balance sheets balance, and so we put together a short video in which we strip back to real basics to show you the essential techniques that you need to build a balancing three-statement model. I'm going to hand over to one of our consultants, Evie Murphy, to show you how it's done.
In this video, we are going to look at how to link up a simple integrated three-statement model. The best way to do this is to build up these statements step by step, making sure your balance sheet is balanced as you go along. In this example, we already have a template set up for our profit and loss account, our balance sheet, and our cash flow. We also have an input sheet here with our revenue, costs, and tax inputs already pre-populated, and then further balance sheet inputs below for working capital and our opening balances for our balance sheet items. The first thing we normally start with in building a model is setting up the retained profit control account. This is so when we start linking up our P&L lines, our balance sheet will automatically balance. We already have a template for our retained profit control account. This control account is set up using a corkscrew technique, which is also known as a roll forward calculation. The opening balance row is linking to the closing balance of the prior period, and the closing balance is the sum of both the opening balance and the movement in the period. The first thing we need to do is link up the opening balance in the period prior to the timeline start date. This links up to one of our opening balance inputs. As you can see in this example, it's 0. We then need to link the movement in the year to the profit after tax value in the profit and loss report. Then we need to link the closing balance to the balance sheet. The next item we need to calculate and include in the balance sheet is cash. We have already set up a simple cash calculation which works in the similar way to the retained profit. Where the opening balance equals the prior period's closing balance. At the moment, there is no movement in cash during the year to link up, but there is a starting cash balance, which we need to link up in cell K19. As there is no movement in cash during the year, we can see that the closing cash balance is always 2,000 in each period. Let's link this up to the balance sheet. On our balance sheet, we have a check to ensure that the net assets are equal to our total equity. At the moment, you can see that this doesn't balance, and then there is a £2,000 difference. Let's set up the shareholders' equity to get this to balance. The control account for share capital is very simple, as we are assuming there are no shares being bought or sold, so there is no movement in each period. We just need to link up our opening balance value and then link the closing balance to the balance sheet. You can see now that the balance sheet balances and our checks are now okay. Now we can start looking at our profit and loss account. The first thing we need to link up on our profit and loss account is sales. In this template, we already have a sales calculation set up. This is a very simple calculation as we have an input for the revenue in real terms, which we just need to multiply by the inflation factor to get us to our inflated revenue value. The inflation factor is calculated on a separate sheet and is calculated by multiplying the prior period's inflation factor by the inflation rate, which in this scenario is 3%. So let's link up our revenue line to the P&L. You can see now that the balance sheet no longer balances. This is because we haven't completed the double entry for revenue and only credited the P&L. Therefore, we also need to debit cash. We will do this on our cash calc we started earlier. In the cash movements line for sales, we will add our revenue received. You can therefore see in the closing balance we have increased our closing balance of cash by 15,450, giving us a closing balance of 17,450. As we have already linked our cash at bank balance to the balance sheet, you can see that our checks are now okay and the balance sheet balances once again. We also have a cash flow statement, which we also need to link up the revenue cash flow. You can see now that our cash flow is now equal to our cash calculation movements. The next thing we need to do is link up our operating costs. Our operating costs are very similar to the sales calculations. We have our real cost for rent, which is £10,000 per year, and then our inflation factor, which is using the same inflation factor we have used for sales. We then have our nominal rent calculation, which is multiplying the real cost by the inflation factor. Let's link this up to the P&L. Again, you can see that this means that our balance sheet no longer balances, as we have debited expense on the P&L and have not yet credited costs. Let's add the cost line to both our cash calc and the cash flow report. As we have now added both revenue and cost to our P&L, if we look at our retained profit calculation, you can see that the profit movement in the year has been automatically updated to show the net profit in the year. This means that our balance sheet has now balanced. The next thing we need to think about is working capital. In our inputs, we are told that our trade debtor days are 60 days, so we will not receive the revenue until 60 days after this has been recognised on the P&L. Therefore, we need to set up a trade debtors working. Our normal way of calculating trade debtors is to calculate the expected closing balance using sales and the debtor days input. Then we will calculate the cash received as the balancing figure. In the blue cells here, we have brought through the debtor days input days in year, and the sales value. The closing trade debtors figure is then the revenue multiplied by debtor days and divided by days in year. We can now bring this down to our control account below. The closing balance is already linked up to our closing balance earlier, but we need to bring through our opening balance in cell K19, which in this scenario is 0. We then need to include our sales value. Then the cash received is the balancing figure, which is the closing balance minus the opening balance and the sales figure. We can now link this up to our balance sheet. Notice that our balance sheet no longer balances. This is because our revenue is still being included in the cash calculation from before. Instead, we need to update this with our cash received figure. As we are receiving this cash, this value is positive, even though the value is negative in our control account. Let's also update the cash calculation. Our balance sheet now balances again. The last thing we need to do in this example is to add tax. We have an input for our tax rate at 20%. All we need to do is pull through our profit before tax figure. We can then calculate our corporation tax by multiplying our profit before tax by our taxation rate. Notice that we have included a max function in here, so we are not multiplying the tax rate by a negative value, as we wouldn't be taxed in that year. In this model, we're assuming that tax is paid in the same year. Let's pull that through to the P&L. As we assume that tax is paid in the same period as it's expensed, let's pull this through to the cash flow here. The cash flow now doesn't match up with our cash calcs. Let's add the tax paid in here too. Our checks are now 0, as our cash flow and our cash movements in our cash calcs are the same. You can see now that we now have a completed profit and loss account with sales, costs and tax, and a balancing balance sheet.
So the key takeaways from that are, first of all, that we should use error checks. This can tell you if anything goes out of balance, and you can use these to check, for example, also whether cash and net profit reconcile to balance sheet movements. One of the first things you should do is set up your skeleton balance sheet with retained earnings and cash. This should balance before you start adding anything else. Key message really here is keep it simple, take small steps. Notice how EV treated sales as cash sales initially and then adapted the calculation to deal with the debtor. Each time you add a new row to the reports, you should think about the impact of that entry on each of the 3 statements and how you should deal with that. Make sure your balance sheet is never out of balance after finishing a line entry. If there is a problem, then go back and fix it before you move on. And to be really sure your balance sheet will always stay in balance, then it's a good idea to use non-zero figures. Use dummy figures if you have to, so that errors will show up in your error checks, and then replace these later by the actual figures. I hope that's helpful. Thanks for watching.